In today's video, you shall learn the basics of technical analysis. Technical analysis is crucial to traders because of two words: smart money. Loss prevention. Knowledge is your armor. Stop bleeding cash because you didn't get the market. Profit hunting. Spot trends, reversals, and setups before they become everyone else's gains. I will explain what is technical analysis and why it is important for traders to understand it. What is candlestick? Some candlestick pattern and their practical application in trading. What is pattern? Various types of pattern and their practical application in trading. What is a trend? Types of trend and their practical application in trading. What is indicator and types of indicators? What is technical analysis? It is using past price and volume data to predict future price movements. Think of TA as the market's DNA. It's based on two rules. History repeats itself. Human psychology drives patterns. Price discounts everything. News and emotions are already baked in. What is a candlestick? A candlestick is a visual representation of price movement for a specific time period: minutes, hours, day, week, month, etc. in financial markets. Candlestick charts are cornerstone in technical analysis and perhaps one of the earliest forms of technical analysis. Anatomy of candlestick. Each part holds a different piece of information. The body. This is the thick part of the candlestick and represents the range between the opening price and the closing price for that period. Green body means the closing price was higher than the opening price. The market has moved up. The market is bullish over the period of the candlestick. Red body means the market has moved down. The market is bearish over the period of the candlestick. The wick shadow. The upper wick, upper shadow, shows the highest price reached during the period. The lower wick, also known as the tail, shows the lowest price reached during the period. A candle has 4 price data points. Open price. The first trade price during the period specified by the candle, close price. The last trade price during the period specified by the candle, high price. The highest traded price, low price. The lowest traded price. Candlestick patterns. Candlestick patterns are one of the most commonly used tools in technical analysis, helping traders quickly grasp market sentiment and potential trend changes. Below are some popular candlestick patterns frequently employed by traders. Hammer, a bullish reversal pattern that typically appears at the end of a downtrend. It has a small real body, usually at the upper part of the price range, with a lower shadow at least twice the length of the real body. Inverted hammer also appears at the end of a downtrend. Its real body is small, located at the lower part of the price range, with an upper shadow at least twice the length of the real body. It suggests a potential bullish reversal, but requires confirmation from subsequent candles. Shooting star, a bearish reversal pattern that usually occurs at the end of an uptrend. It resembles an inverted hammer but appears at the top of an uptrend. It has a small real body located at the lower part of the price range with a long upper shadow. Like the inverted hammer, it requires confirmation from follow-up candles. Bullish engulfing, composed of 2 candlesticks. The first is a black candle in a downtrend, followed by a white candle whose real body completely engulfs the real body of the previous black candle. It indicates strong buying pressure and a potential trend reversal. Bearish engulfing, the counterpart to the bullish engulfing pattern. It consists of a white candle followed by a black candle in an uptrend, with the black candle's real body completely engulfing the white candle's real body. It signals a potential trend reversal to the downside. What are indicators? Technical indicators are essential tools for traders to analyze market conditions and identify potential trading opportunities. Below are some of the most popular technical indicators commonly used by practitioners. Trend indicators. Moving average, MA, a classic trend indicator that smooths price data to identify trends. Common types include simple moving average, SMA, and exponential moving average, EMA. Traders often use the intersection of different moving averages as buy or sell signals. For example, a golden cross, short-term MA crossing above long-term MA, may indicate a buy signal, while a death cross, short-term MA crossing below long-term MA, may signal a sell. Relative Strength Index, RSI, a momentum oscillator ranging from 0 to 100. It compares recent price gains to recent price losses to measure the speed and magnitude of price changes. Typically, an RSI above 70 indicates overbought conditions, while below 30 suggests oversold conditions. Traders use divergence between RSI and price movements to predict potential trend reversals. For instance, if price continues to rise but RSI fails to surpass its previous high, it may signal a potential price reversal. Bollinger Bands, a volatility indicator comprising three lines: a middle line, simple moving average, an upper band, and a lower band. The upper and lower bands are calculated based on the standard deviation of the moving average. When prices touch or exceed the upper band, the asset may be overbought. When prices reach the lower band, it may indicate oversold conditions. Bollinger Bands can help traders identify potential market reversal points. What is a trend? A trend is the general direction in which a financial asset's price is moving over a period of time. It's like the market's mood: optimistic, pessimistic, or neutral. And here's the kicker: trends are your best friends in trading. Why? Because they show you the path of least resistance. Trade with the trend, and you're swimming with the current instead of against it. Types of trends. There are three main types of trends you need to know. Uptrend, higher highs and higher lows. The market is climbing like a staircase. Downtrend, lower highs and lower lows. Prices are descending like a slide. Sideways horizontal trend. Prices are range-bound, moving within a corridor. It's like the market is taking a breather. How to identify trends? Identifying trends is both art and science. Here are your go-to tools. Trend lines. Draw a straight line connecting highs for downtrends or lows for uptrends. The slope tells the story. Moving averages. A simple moving average SMA can smooth out price data. If the price is above the SMA, it's likely an uptrend. Trading the trend. Let's turn theory into cash. Two strategies. Trendline bounce. Buy when price touches the trend line with a bullish candle. Place stop loss below the line. Take profit at the next resistance. Breakout trade, downtrend. Short when price smashes the trend line. Confirm with a bearish candle. Stop loss above the breakout point. What are trading patterns? Trading patterns are recurring price formations indicating potential future movements. They reflect market psychology, like investor emotions and behaviors. Think of them as the market's body language, revealing intentions. Below are some of the most popular market patterns in technical analysis. Reversal patterns. Head and shoulders. This is a highly reliable reversal pattern. It consists of a peak, the head, followed by two smaller peaks, the shoulders, on either side. When the price breaks below the neckline, the trend line connecting the bottoms of the two shoulders, it signals a potential reversal of the uptrend. Inverse head and shoulders, the opposite of the head and shoulders pattern. It features a trough, the head, and two smaller troughs, the shoulders. A breakout above the neckline indicates a potential reversal of the downtrend. Triangle. There are three types of triangles: ascending, descending, and symmetrical. In an ascending triangle, the price forms higher lows while the resistance level remains relatively horizontal, indicating increasing buying pressure. In a descending triangle, the price forms lower highs while the support level remains relatively horizontal, suggesting increasing selling pressure. A symmetrical triangle is formed by converging support and resistance lines, with the price making smaller and smaller swings. Triangles typically act as continuation patterns, with the price breaking out in the direction of the existing trend once the pattern is completed. Technical analysis isn't a secret club. It's your ticket to trading freedom. Whether you're in stocks, crypto, or Forex, these tools turn chaos into clarity. So, what's next? Stay sharp, stay stacked, and we'll see you in the next video.